Hello everyone, welcome to the market opening bell on Friday, November 7th, your 10-minute guide to the stock market. Hong Kong stocks rose in line with overseas markets. The Hang Seng Index opened 126 points higher, with gains expanding throughout the day. It peaked at 26,490 after rising as much as 555 points, closing up 550 points or 2.1% at 26,485. The H-share index rose 192 points or 2.1% to 9,355. The Hang Seng Tech Index climbed 158 points or 2.7% to 5,944. Total market turnover was 234.6 billion Hong Kong dollars. Mainland funds traded $105.7 billion, with net southbound inflows of $5.479 billion. Key net buys included Xpeng, $1.214 billion, CSOP Hang Seng Tech Index ETF, $1.052 billion, Hua Hong Semiconductor, $961 million, Xiaomi, $662 million, SMIC, $618 million, Tencent, $364 million. Net sales included Weichai Power, $548 million, PopMart, $418 million, Alibaba, $308 million, and Meituan, $203 million. Statistically, southbound funds have net bought Xiaomi for 7 consecutive days, totaling $4.228 billion. Technically, the Hang Seng Index alternates between gains and losses, continuing to fluctuate between 25,600 and 26,600, awaiting a breakout. Mainland A-shares opened higher and closed strong. The Shanghai Composite Index reclaimed the 4,000 level, closing at 4,007, up 38 points or 1%. The Shenzhen Component Index closed at 13,452, up 228 points or 1.7%. The Chinex Index closed at 3,224, up 58 points or 1.8%. Total turnover in Shanghai and Shenzhen reached 2.0523 trillion yuan. The renminbi-US dollar central parity rate was raised 36 points to 7.0865. Chip stocks performed strongly in both Hong Kong and mainland markets. Reports indicate China issued guidance requiring all new data center projects funded by state money to use domestic AI chips. If construction is less than 30% complete and foreign AI chips have already been used or purchased, they must be dismantled or contracts cancelled. It is unclear whether the guidance is nationwide or limited to certain provinces, and the issuing authority was not disclosed. Hua Hong Semiconductor announced Q3 results after market close. Net profit of $25.725 million, down 42.6% year over year, but up 223.5% quarter over quarter. Basic earning per share of 1.5 US cents. The company shipped approximately 1.4 million wafers, up 16.7% year over year. Revenue hit the record $635 million, up 20.7% year over year and 12.2% quarter over quarter, driven by higher wafer shipments and rising average selling prices. Gross margin improved 1.3 percentage points to 13.5%. The company expects Q4 revenue of $650 to $660 million, with gross margin of 12% to 14%. Cathay Pacific announced an irrevocable agreement with its third-largest shareholder, Qatar Airways, to repurchase 643 million shares, equivalent to 9.57% stake at 10.8374 Hong Kong dollars per share, totaling approximately 6.969 billion Hong Kong dollars. The deal requires approval by at least 75% of independent shareholders at an EGM. Cathay cited 3 reasons: enhancing EPS, sufficient cash for operations and growth, and allowing Qatar Airways an orderly exit to avoid market volatility. However, some interpret this negatively. Qatar may lack confidence in Cathay's future and the repurchased shares will be held as treasury stock without mention of cancellation. Weichai Power signed the production license agreement with UK clean energy tech firm Sears Power to manufacture its solid oxide fuel cell (SOFC) systems in China. Shares surged 20%. The SOFC targets stationary power for AI data centers, commercial buildings, and industry. Galaxy Entertainment reported Q3 net revenue up 14% year-over-year to 12.2 billion Hong Kong dollars and up 1% quarter-over-quarter. Adjusted EBITDA rose 14% year-over-year to 3.3 billion Hong Kong dollars, but fell 8% quarter-over-quarter. Gross gaming revenue was 12.2 billion Hong Kong dollars, up 21% year-over-year and 2% quarter-over-quarter. Two factors impacted performance. September is seasonally weak as travelers delay trips for Golden Week, and Typhoon Kornu forced a 33-hour casino closure. Galaxy closed its Wado Casino on October 31st. Cotai Phase 4 is targeted for completion in 2027. Cathay Coral Holdings issued a profit warning. Adjusted EBITDA for the 6 months ending September 30, 2025 is expected to fall around 30% from last year's 344 million Hong Kong dollars. Shareholders' profit is forecast to drop 65% to 70% from $144 million. Management is leading 2 task forces to transform operations, shifting to more flexible models, consolidating underperforming stores, streamlining menus while maintaining quality, and upgrading supply chains in Hong Kong and mainland China. High valuation AI stocks faced selling pressures. U.S. markets opened lower and closed weak. The VIX Fear Index rose 1.49 points or 8.3% to 19.5. The Dow fell as much as 523 points or 1.1%, closing down 398 points or 0.8% at 46,912. The S&P 500 dropped 75 points or 1.1% to 6,720. Nasdaq plunged 445 points or 1.9% to 23,053. The Nasdaq Golden Dragon China Index, tracking Chinese ADRs, fell 3 points or 0.23% to 8,134. Cheap stocks tumbled. Nvidia around 3.7%, AMD around 70.3%, Patentia down 6.8%. Qualcomm reported a Q4 net loss of $3.12 billion, down 3.6%. ARM Q2 revenue up 34% with strong guidance, but still fell 1.2%. Other tech names weakened. Meta and Microsoft down 2%, Tesla down 3.5%, Amazon down 2.9%, Apple down 0.1%. On earnings, Expedia Group Q3 adjusted earnings per share was $7.57, up 23%, beating estimates of $6.97. Revenue up 9% to $4.41 billion, above $4.28 billion expected. Q4 revenue growth guidance at 7% midpoint, well above 2.6% expected. Full year sales growth upgraded to 6.5% from 4%. After hours, share price up 13%. Airbnb Q3 net profit was $1.37 billion, below $1.46 billion expected. Revenue up 10% to $4.1 billion, beating estimates. Adjusted EBITDA was $2.1 billion, above forecast. Full year adjusted EBITDA margin now at 35%, up from at least 34.5%. After hours, share price up 5%. Per Challenger, Gray and Christmas, U.S. employers announced 153,074 layoffs in October, the highest for the month since 2003, versus 54,064 in September. Year-to-date through October, there were 1,099,500 layoffs, the highest since the pandemic, and 44% above 2024's full year 761,358. Government led with 307,638 cuts, followed by tech at 141,159 cuts. Post-pandemic hiring surges are reversing amid AI adoption, slowing consumer corporate spending and rising costs. Re-employment is becoming harder, potentially loosening the labor market further. Our stock pick today is Zhou Liufu. After more than 21 years of steady development, Zhou Liufu has built a strong brand matrix with its core classic brand, Zhou Liufu, at the center, complemented by emerging sub-brands Chaojin and Fans, forming a diversified and complementary brand ecosystem. The group has achieved balanced development in both franchising and self-operated models, accumulating extensive B2B franchise cooperation experience, as well as strong online and offline C2C sales capabilities. Leveraging these core strengths, the group plans to actively innovate and optimize its whole brand operation and cooperation models to create new profit growth engines, empower offline store expansion, and enhance per-store revenue and market share. As of June 30, 2025, the group operated a total of 3,760 franchise stores and 97 self-operated stores. Over the past 2 years, through a structural adjustment focused on survival of the fittest, the group has achieved efficient optimization and quality upgrades. To further amplify brand momentum, the group has introduced a novel collaboration model called Cooperative Partnership Store. This involves partnering with strong franchisees to jointly invest in and operate 3 excellent stores, prime locations, premium products, and outstanding operations. Both parties will fully leverage their respective expertise in site selection, product curation, marketing and traffic generation, and retail management, sharing operational results. This model is expected to diversify investment risks, stimulate store opening enthusiasm, and drive growth in store count and per-store revenue, positively impacting the group's performance. According to the group, the 2 emerging sub-brands are in a high-growth phase with significant market potential and clear differentiated positioning from the main brand. Chaojin focuses on trendy, fashionable, and personalized gold products, leading fashion trends among young consumers. Fans emphasizes strongly designed light luxury and youthful inlaid jewelry, meeting the demand for quality and innovation in the premium segment. Tailored to these sub-brands' characteristics, the group has introduced the Co-Creation Partnership Program, selecting like-minded and capable provincial agents to jointly establish brand-specific joint venture entities for deep and comprehensive cooperation. Through this platform, partners will share multiple revenue streams, including brand licensing, wholesale sales, and online-offline C2C sales, achieving resource complementarity, risk sharing, and profit sharing to jointly tap vast market opportunities. This initiative is expected to accelerate sub-brand market penetration and sales growth, further solidifying the group's leading position in the jewelry industry. Buy recommendation at 46.5 Hong Kong dollars, initial target $49.5, secondary target $51.5, stop loss $44. I do not hold the above stock.